GM. GM. Saturday, 27th of April, day 10. I just made that up, but is it day 10? Day 14 of slow death grind. Since the 13th of April, Saturday, when we had that war panic overnight, we've just seen the bull market end. When I say bull market, I should really not say that. I should say bull cycle, bull phase. But the bull trend is over for now. There's a huge difference, right, between everything that happened here on the left-hand side, and even this, that's fine, and that bounce, that's fine, and this consolidation, that's fine. That is the big shift. There. That's the one. And it's not just on WIF, it's on the total market cap too. It was actually the Friday it started, but it was Saturday that broke everything. That took the wind out of the market. That's it. Right? That is the confirmation of the end of that trend. And slowly people are waking up to this realization. I mentioned it at the time that leave the market for a week and just see what happens. And we did what you'd expect it to do. It went sideways and chopped. Then it tried to go up. Okay, so, look at Bitcoin, for example. Leave it for a week, I said over here. 1, 2, 3, 4, 5, 6, 7 days. Tried to rally up, touched off, took some liquidity, fallen back down. But memes and altcoins show an even clearer story, right? Consolidated for a week, tried to move up, big rejection, first time rejected, right back to where it came from, done. Now, very simply, two paths you can do. One, you go lower. Two, you don't go lower, and you chop around. I've been over this a bunch. A lot of this, if I'm right, a lot of what I'll do in the next month or so is just educational stuff, reminding you to be patient, helping you set up systems and ideas, and posted the dashboard this morning so you can look into, everyone should check it out. You can look into VCs, right? There's a new dashboard. You can look into the VCs and how much profit they're in on their investments and which ones maybe to avoid. Doesn't mean avoid them all, but it can tell you that, like, did you know, for example, the Athena investors, right? The VCs are in Athena, the new hyped up project that everyone was all high about. The investors in Athena are up 150x, even at current level. 151 Athena. So at the current price, Athena early investors are up 150x. So even if it goes down 50%, they're still up. If it goes down 90%, they're still up. If it goes down 99%, they're still up. Definitely one to check the token unlock schedule on. I don't think there won't be any tokens unlocking probably for a year or more, but that kind of shit, not bullish in this cycle, in my opinion. Now, to add insult to injury, we've had a repeat. Another outflow day with Fidelity dumping more, BlackRock with zero again. Again, slowly people are waking up, super slowly, to the fact that this is not a current bull trend. Again, bull market, bull trend, different things. But if we go lower, if we go into the 50s, is this a bull market? Well, it wouldn't have been a bull market since the 14th of March. It'd be a high, a low, a lower high, a lower low, a lower high, a lower low, and you'd be in a bearish trend. Which is fine. I've said a million times, getting long is the main focus here. But what you want to make sure you don't do is get long too soon. because this is probably going to be slow and choppy and grinding. I do think we resume and go much, much, much higher, but we have to get to a point where people think it's over. Right now, it's people thinking very much along the lines of what I'm saying. People thinking, yeah, we'll go down a bit. Yeah, we'll chop a bit. Yes, it'll be low volatility. It'll be sideways, but it's fine. Right? Because if we follow any of these paths, and by the way, here's something important. None of these paths are going to play out. Right? And that's the whole point. Because what's going to happen is something different. And the reason why it's going to be something different is because it has to feel like it's over or confusing. Let me explain. Everyone who, you watch this video, right, and I lay out these three paths, and you think, well, if Bitcoin follows any of these three paths, I'll be fine. Michael's telling me that I wait a couple of weeks, wait for it to start showing support, wait for the volatility to compress, and that's the place to get long. Now, this idea is exactly right. You do want to wait for volatility to compress, you do want to wait for a support to form, and then you want to get long when it starts to show signs again, bands go green. But when you look at this, you think, oh, so it's down a little bit more, even in the worst case scenario, down a little bit more, sideways for a month, and then we go up again. Cool, I can handle that. But what might actually happen is something entirely different. Right? It could be a violent move up and a massive dump down, and then a grind and a grind and a grind, way lower than anyone thinks, all the way down to here, and then a false rally and back down and down once more, and then everyone thinks it's really done and away it goes. Right? I have just completely made this path up, as you can imagine. The point is, what I've learned, like I learned this fucking a long time ago, that even when you draw multiple paths, right? Because when you first start trading, you draw one path. You're like, okay, it's a bull market, I want to be bullish, so I'm going to draw this path. And that's the path that must go. And you don't draw anything else. And then you realize, every time I seem to draw my ideal path, price doesn't follow it, and then I lose money because I don't know how to trade it, right? Because if it doesn't follow my perfect path, then I'm stuck. So then you realize, oh, I should draw two paths. I should draw a bullish path and a bearish path. And then you realize, and this is exactly how I learned how to trade. And then I realized, oh, so I would draw like a bullish, right? I would start off when I was trading, price would be like this, right? And I would draw my paths. And I would draw the bullish path, and I'd be like, price is going to go like this, it's going to flip it, it's going to nice support resistance flip, boom, away it goes. And then that wouldn't happen. And I was like, okay, I need to draw an alternative path. I should also consider the downside. So it could also go down, turn support into resistance, and go lower. Cool. Now I'm starting to think in not in binary terms. I'm starting to think of multiple different potential realities. And that's good. That's better than the first one. But then you realize the key flaw in both of these is that you're expecting price to move. Because our brains can only really think in terms of the bull. See if I can draw a bull here. This would be G. The arrows don't help. That's close enough. Or the bear. This is going to be the worst bear ever. It's definitely a hippo. So we can only think in terms of bullish or bearish, good or bad. And the problem with that is the market is not always bullish or bearish, especially when you're looking at the time frames we trade on. So quite often what actually happens is it goes up a bit, it goes down a bit, it doesn't really go anywhere for a while, and then it makes a directional move. And the point is, you're doing the analysis on the 30th of December here. If you look at the bottom, you're doing the analysis on the 30th of December. And you want it to go up right away or down right away. You don't want to wait until the 12th of February for the actual down move. But that's how markets move. So then you reach that next level where you consider a bullish path, a bearish path, and a path where it doesn't go anywhere initially, which generally is the way it goes. And then, finally, you realize after you've done that a bunch of times, and you're at each of these levels, by the way, your trading gets better. When you think of one path, you're a average trader. When you think of two paths, you get slightly better because you don't be as biased to bull or bear. When you think of that third path, you become way better because you learn patience. You're like, holy shit, this might take 34 days to break down. I have to be ready for that. Right? You know, from the moment it got bearish, from the moment, hindsight's 2020 of course, but from the moment it got bearish over here, and the bands went red and we had an impulse lower, right? That was when I was long at that time and I abandoned my long position after that broke. After that impulse candle, and it was undeniably bearish, it took 24th of July until the 17th of August to actually impulse and break down. Right? That's 3 weeks. More than 3 weeks. This is how it actually goes. Because when that impulse candle happens and you do your analysis on the 25th of July, the next day, you're like, well, it can go like that, or we can squeeze the shorts. Right? That's always the first ideas that come to your mind are always, how do we go up? How do we go down? Because you're going to look at data. You're like, okay, downside, well, look at this. We've just broken down and we're in a gap. That gap can fill, and look, it filled in 2 days last time. So that gap can fill probably in the next couple of days. Boom. It's just going to collapse. And guess what it did? Just 3 weeks later. Right? Or you're looking at the open interest. Open interest has been rising on the way down. Funding rate's gone negative. CVD's doing this. Looks like there's some shorts coming in. Right? We build up here. We're going to squeeze them. And of course, the path that most people ignore is the path that it often ends up taking, which is brutal chop. Consolidation. Because look at every single impulse. The bigger the impulse, the longer the chop. Right? 3 days of real nice price action. 3 days of beautiful trending price action. 1, the breakout. 2, the big expansion. 3, the final push. Followed by, from the 22nd to the 15th. I mean, almost 2 months of nothingness. This impulse doesn't count. That doesn't count. It's only in hindsight that they look like good moves. This entire thing was a mess. Chop, 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 chop. Great trading conditions for scalping, low time frame, sure. But the 3-day pump puts everyone into the mindset of it's a bullish trend. So they're all trending along. They're long the dip and it holds the bands, they're long the dip and they're waiting for the dip and long. And when you realize this, you get a lot better at just intuitively understanding when to trade, when not to trade. The big impulsive move makes everybody just go hunting for longs. And so they'll long everything and long everything and long everything. Impulses, the big impulse leads to chop. Very, 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 very common. Massive, fast impulse lower. Eventually we break the camel's back. 3 days down. Boom. Down, down, down. Immediately followed by months, literally 2 months, of brutal, directionless chop. And so, where are we at right now? Well, we are months in. Well, we're almost 2 months in to our shitty choppy phase, but it didn't really, even though like the range is still valid here, this was trending, this was trending, this was absolutely trending, big shakeout, bought back up. So the brutal chop started here, so 14th of March. So we're chopping and chopping and chopping and chopping and chopping, but the sentiment of the market is different because at this point here we were not bearish. Sentiment wasn't bearish. There was no reason to be bearish. It was buy the dip. So this was not considered chop. Chop is where it gets directionless and people are flip-flopping bullish, bearish, bullish, bearish. This wasn't that. This had a pretty quick correction, sell-off, right? Some people got liquidated, some people sold, some people panicked, yes. But as soon as we pop back above these green bands, people are like, oh, it's bullish again. And then even when we had the little sell-off, people are like, bands are still green. And they pop back up, oh, look, green, bullish, 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 bullish. It's all good. Breakout coming soon. And especially when they're up there. And so at what point do people actually accept that it's over? Not here. This is all still bullish. And it was the 12th and 13th of April, right? That is the first time, and you could feel it. Remember that with the war fears, blah, blah, blah. It was the first time the market actually went risk off. And then people tried to ignore that. It goes, no, war is good for Bitcoin. It's not about war. This move would have happened anyway. It was not about war. That move was going to happen anyway because supply and demand dictate so. So the market's actually gone risk off for the first time since over here. Now, I'd argue that there was definitely there was a lot of bearish sentiment. A lot of people thought sell the news, etc. But we didn't have such a build-up of positioning, meaning we didn't have this huge trend and the 100x meme coins and altcoins and everything going crazy and all these people getting over allocated. So this is like January but on steroids. It's so much bigger, and that usually means we're going to go actually much lower or have a longer brutal chop. So in looking ahead, I have all these paths in my mind, and I know that the one that plays out will be different. The key thing here is time. It's all about time. There is not enough pain. There's just not enough pain. We're at the point now where everyone's like, well, what's the point selling? Like, that's literally the mindset. What's the point of selling? Better just sit tight. And I've been there before in previous cycles. That is where you eat another 50% drawdown on your meme coin, altcoin. And then it doesn't just go down 50%, it goes down 50% and it goes sideways for weeks to punish you for your bad decision. And then eventually it will grind you into submission and you'll quit, and then it'll go up again. Those are just the rules. I don't make the rules. That's just how it goes. It would take a miracle from God to rescue this market right now. Now, there are some things, mostly around this. So we've seen weak, like the last 3 days especially, ETFs are the most bearish they've been. Now, it's all relative, of course. The ETFs have still taken in billions of dollars. But undeniably, BlackRock 3 days is 0 in a row. Right? 1 could be a coincidence. Oh, it's just 1. 2, you'd be like, well, maybe someone's on holiday this week and maybe they're just not pushing it so hard. 3, you're like, okay, no one's fucking buying right now. So they've tapped out their initial sales pipeline, which is fine. They did take in 15 billion. So it's not really surprising that they stopped. But they have stopped. And we've outflows on every day. And we have fucking duck eggs everywhere, zeros everywhere. And we have Fidelity continuing to sell. And so it's not good. And how have the last 3 days of price action looked for Bitcoin? Not great either, right? Now, a lot of, it can be true that we're not as low as you might expect with weak outflows, right? Meaning, and I've seen this a few times online, I'm like, oh, BlackRock's not even buying anymore, Fidelity's selling, and there's net outflows every day for the past 3 days, and we're still at 63k? Wow, that's pretty strong. The problem with that logic is, it just means we haven't broken down yet. The flows are lagging, right? But there's this weird interplay where you find out the flows after, right, the end of the day, and as the flows are happening, the insiders of Wall Street already know, right? So by the time BlackRock reports their zero at 5 a.m. UTC, usually when it is, or whatever, 4 a.m. UTC, they've known that since 10 p.m. the night before. So they've known that for 6, 7, 8 hours, and they're trading around it, right? So in that sense, they're lagging. So price shouldn't go down after in an efficient market, but the market's not efficient. If there's a bad day of flows, price shouldn't go down afterwards because it should already have been front run. By the time the news is out, you should actually see price stabilize because those flows should have been front ran by BlackRock and Fidelity and the insiders and fucking JP Morgan and all the authorized participants in Jane Street, etc., 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 right? But there's an interesting interplay to where the data is lagging, but the expectations moving forward are leading. So you have the lagging data of what the flows were. So you look at what the flows were yesterday, and then we know what the flows were. But of course, that makes people then say, what are the flows going to be on Monday? So how does this weekend look? Is this weekend going to set up for a big short squeeze because we had really bad ETF flows and everybody is expecting ETF flows to continue being bad next week and they're worried that the market's looking shaky and they want to sell their Bitcoin over the weekend or sell altcoins or short stuff? That logic is solid. People are definitely doing that. There's definitely some people dumping right now. There's definitely some people shorting and selling thinking that, oh shit, it's going to get worse next week. Now here's the tricky part. It's like, okay, well, does that mean that we are going to have a pump to squeeze shorts? Because you have to be very careful about trying to take counter trend moves. We're not in an uptrend. And if your logic is that people are too bearish, so I should get long because there's going to be a short squeeze, don't forget you're fighting the trend. The trend is down. You're fighting the trend. And you can't fight the trend based on opinion. Because imagine that everybody is selling because the ETFs are weak. That selling pressure is going to overwhelm anyone. Like, who's going to step in and buy it? No one's going to step in and buy it to squeeze the short. There's a big difference. If people are actually selling their coins, dumping their alts, dumping their Bitcoin, selling their coins because they think it's going to get worse, that sell pressure, at least initially, is just going to make it go lower. You need to really understand the data if you're going to try and take longs against that, because you have to not just see, if you see spot selling, that's going to continue it lower. You need to be able to spot signs that shorts are actually building up. Right? There's a big difference between people closing their longs, getting stopped out of longs, selling their spot. Right? Those are three ways of selling. You can close your long trade in profit. Right? So maybe someone's long Bitcoin from 51k and decided, you know what, I'm getting out, looks shaky. There's no short squeeze there. That's somebody selling their Bitcoin long to realize the profit. Then there's people who are underwater, who are closing their long at a loss. Same thing, not a short squeeze. Then there are people who are selling their spot bags at a loss or in profit. Again, can't be squeezed. Then, after those main sources of selling, then you have people who say, I'm going to actually short this thing to try and make money on the way down. But I take you back to previous. Where was which example did I use? It's all over here, right? Yeah. I take you back to previous, right? It looked really bad here. And a lot of people had the bright idea of shorting or longing. Long the squeeze? Well, we got a squeeze. Look at this, these 2 days. Squeezed out everybody on that low time frame. But probably not enough of what people wanted. People wanted, no, it's going to take the liquidity. It's going to dump lower. Right? So, I think it's going to be frustrating for people. And I just don't see this as being a great position for shorts. It's not a great position for longs either. Like, when you invalidate these levels, so there's a level there, like sweep out, held, and this isn't invalidated, by the way. I probably have slightly misspoke. It's not even invalidated this. This is played out perfectly. This is a really good example. That reversal candle, and I scalped long on that yesterday. That reversal candle, on Thursday, on the GDP data, right? The GDP data came out, it dumped down, it took out the lows, it rallied back up, and that was a beautiful, perfect reversal candle, and it produced what you'd expect, which is an impulse higher and pushed up and up and up, and guess what? Took out those highs into the 4-hour bands, and that was it. A lot of people look at that and think, oh, that's weak, that's a failure, it took liquidity and it had a reaction. This is important to remember. That was the trade. That was the reaction. That's what Bitcoin did, right? Just because it didn't equal a bottom, because we went lower, just because it didn't equal a bottom, and it didn't consolidate and go to new highs, or it didn't squeeze straight up to new highs, stop trying to enforce your opinion onto the market. Take it for what it actually is, rather than what you want it to be, right? That, if you're a liquidity trader, all you expect when key liquidity gets hit is you expect a reaction. Now, the exact same thing happened here, because after that move, what would happen? People long there, right? So I'll dip down to a 1 hour time frame here. After this move here, which I'll take away, after we push back up and we close and we have an impulse candle, right? How many people do you think started to get long there? Loads. Where do they put their stop? Where the dotted red line is. What happens when we come down? We break down through it and we get a reaction. Pushes down through it, bounces back above, and here we are inside. That's it. It doesn't have to. Now, it might go up. It might pump up a little bit more and then down. It might just go straight down. The point is, the liquidity is there. The liquidity got hit. It didn't break down, so anyone who shorted into it got squeezed back inside. But that might be it. This is a key feature of CHOP. Many, many, many liquidity grabs, reverse, liquidity grab, reverse, liquidity grab, reverse. Look at this. Exactly the same. Sweeps out the liquidity, quick bounce into the bands. Sweeps out the liquidity, quick bounce into the bands. Sweeps out the liquidity, quick bounce into the bands. Front runs the low, runs up, takes out liquidity on the other side, down, takes out all that. Takes out the very bottom, right down to the 59, bounce up. And even this one, you're like, holy shit, it took out the 59k wick, rally up, that's got to be it. Nukes down, takes the liquidity, bounce again. It's just grabbing, bouncing, grabbing, bouncing, grabbing, dumping, depending if it's a long or a short. And there isn't really any clear direction to it. It's a lot of noise. It's mostly, largely random. But the predictable part is that you will see a reaction. Right? And that's why scalpers can trade this market so well and anybody else just can't. Because when you're in this phase here, most people who don't do it for a living, who aren't scalpers with systems built that actually just scalp, they just want, and it's really simple, they just want too much. And it's not greed, it's just a lack of understanding. So when this move gets swept out here, the scalper knows to trade it aggressively into resistance, and as soon as there's a sign of resistance, they just get out. Can't even flip the bands back to green, cool, I exit here. In there, out there, done. Comes down again, sweeps out this one, boom, I'm long again, reclaim of the level, rallies all the way up, nice, puts in an overextension, top, lower high bounce, breaks down, bands look weak, over there, exit here, exit anywhere up there. As soon as you see a lack of momentum, you exit, right? As soon as you see a lack of momentum, you exit, because you're a momentum trader. Same thing here, right? Sweeps out the lows, and obviously I'm saying imagine you get long here. I'm not saying that these are easy longs to take. I'm saying one person gets long here, they try and hold it because they want to target 66, because they get that moment, they get that excitement, that thrill, right? And we've all been there. You get that excitement and thrill where you get long here, and then it bounces up to here, and you're like, wait a minute, holy shit! And then you zoom out, and you make the biggest mistake you can make, which is you zoom out, and you're like, holy shit, I'm long from 61.8. Fuck, that could be the bottom. Like, what if we go to 67? Like, holy shit. And you start to, like, overlay your position tool. And then you're like, wow, that would be 12R. But bro, can you imagine that's the bottom, right? Imagine that's the bottom. And you're looking at like this, right? This is what you're actually viewing at the time. You're like, wow. I know I took that trade on the 5-minute chart, but let me just zoom out. Let me check the hourly. Okay, that's looking really strong on the hourly. The bands are green again. I mean, this is looking like a failure to return, right? This is looking like one low, FTR. Wow, this could actually be it. Oh, last time it was over here, right? Last time it did an FTR, it went all the way up to there. So we could see it going back up to 70 quite easily. So I could see price making its way up to 70, and then we'll reassess, and then we'll look at it and we'll think, and what's that? Like 70 would be, wow, 25 hour, holy shit, this big fucking trade. And you do that all the while price is looking like this, and you ignore all the warning signs of price itself, right? Because in this phase here, the price starts to show weakness. There you go. And as a scalper, you're out, right? I don't know which one was I looking at? Sorry, I was looking at over here. Anyway, principle's the same. Whether you caught the low here and held it, right? Or whether you sold it up there, the principle's the same. Your structure's broken. It's taken out the highs. Your 5-minute chart, which you entered on, is now showing you to get out. Stop looking at 70k, 69, 63. That's not the same trade. And boom, you round trip it all the way back to your stop loss and you get stopped out. And that happens over and over and over and over and over again because people are not good at adjusting their time frames. That's why if you're day trading, you day trade. It's not about what if this is the bottom. That's not it. If you also think, right, and this is why you have your multi-time frame analysis. This is a long one, long video, but I want to do more of these kind of lessons because the market's quiet and there's not a whole lot to trade off. If you're looking at like, okay, dips down, double bottom, reclaims, I'm getting long here for a scalp, or I'm getting long on this failure here for a scalp. Cool. If you're also looking at a higher time frame chart and you're thinking, which I'm gonna start doing soonish, I'm gonna start building a preliminary long position in this area if we get it, right? So if we push down into here and we're chopping around, I'll build a long, the beginnings of a swing long, just in case. Why? Because I have this already planned. I have a plan for price coming to a low and then a higher low, right? Some kind of choppy FTR down here. Everyone gets bearish, bullish, bearish, bullish, and that ends up being the bottom. And away we go. I have a plan for that. And I'll plan to build a swing long, so separate. I'll still scalp, long, short, altcoins, Bitcoin, whatever. But for a swing trade, based off of 4-hour candles, or 1-hour candles, or daily candles, whatever, I'll be looking to build one there. Because I have that area. The next area I have to try and build one is below the 60. With the logic being, if that level gets taken out, that's going to take loads of people out, stop loads of people out, flip them all bearish. And if we chop in that area, same thing can happen. Because I am absolutely looking for the bottom. Because I do believe it's still a bull market. And I believe the best trades are on the long side. But that is entirely separate. That's entirely separate to any scalping or day trading you take in between. So you have to separate your time frames. And it's as simple as having a plan. It's as simple as having a plan. I am predominantly trading short at the moment and have been all week. If I'm taking day trades, right? These are holding for a few minutes or a few hours. And yet, at the same time, I'm waiting and want to build a long as a swing. When you trade long enough, you'll just be okay with that. At the start, it's difficult because you're kind of confronted and you're like, oh, it's kind of weird to be bullish, but also bearish and blah, blah. That's part of being a trader. You'll get used to it. Anyway, that's it. GM. 34 minutes. Longer than I wanted. But hopefully you found that valuable. GM.